Here's the truth about financial bubbles. The most terrifying part isn't when everything falls apart. It's that split second when everyone stops questioning anything at all. You know that feeling when prices keep climbing, everyone around you seems confident, and suddenly asking questions makes you look like the fool? Not careless, not reckless, just ... behind the times. Here, S wild. By the time people are casually throwing around the word bubble in normal conversations, the damage is already baked in. And it's not some evil mastermind pulling strings. It's just our own brains playing tricks on us, whispering, "Trust me, it's different this time." This is The Financial Historian, where we dig into the messy intersection of money, power, and the past because nothing is ever as straightforward as it seems. Every single massive financial bubble throughout history, they all have this bizarre thing in common. While they're actually happening, nobody thinks they're being irrational. In fact, it feels completely logical, even responsible. People caught up in it don't think they're gambling wildly. They genuinely believe they're just adjusting to how the world works now. And that's exactly why spotting a bubble from the inside is basically impossible. They never show up waving red flags screaming excess. Instead, they walk in dressed up as innovation and progress. And this isn't some new phenomenon either. Way before computer screens and Silicon Valley investors, humans were going absolutely wild over stuff that seemed like it would change everything. Take tulips in 1600s, Holland. These weren't just pretty flowers. They represented power, exclusivity, and an entirely new way markets could function. Fast forward to the 1800s, and railroads weren't simply about trains and tracks. They symbolized national ambition and destiny. Jump to the 1920s. And radio company stocks weren't just businesses, they were literally the soundtrack of tomorrow. Then the 1990s internet wasn't just connecting computers, it was erasing geographical boundaries forever. Here's the kicker though, every single one of these things was actually real. That matters more than you think. Bubbles aren't built on complete lies, they're built on genuine truth that gets stretched way, way past its limits. The psychology behind all this, it's shockingly predictable. And it starts with something deeply wired into us, our addiction to stories. Think about it, we don't understand the world by staring at spreadsheets and numbers. We understand it through narratives that make sense to us. Stories connect the dots, give meaning to chaos, and calm our anxiety about the unknown. When a really compelling story latches onto some new technology or investment opportunity, that becomes dangerously powerful. The story doesn't follow the numbers follow the story. Once that story takes root in people's minds, actual valuation becomes almost irrelevant. Traditional ways of measuring value, they get tossed aside as outdated relics from a world that doesn't exist anymore. Nobody outright says profits don't matter, they just say not yet. Losses aren't red flags, they're strategic investments in future market dominance. When a story feels true enough, basic math becomes annoying background noise. This is where social proof kicks in big time. When we're uncertain about something, we instinctively look around at what everyone else is doing. If others are buying suddenly feels safer. If people we respect seem confident, our own doubts start feeling unnecessary, even stupid. Markets turbocharge this instinct because rising prices themselves become the proof. Every jump in value reinforces the belief that the story must be correct. I mean, why else would this many people agree? Over time, being skeptical becomes socially costly. Analysts who dare question valuations get labeled as pessimists stuck in the past. Investors sitting on the sidelines feel like they're missing out on something huge. The risk to your career starts outweighing the financial risk. It becomes way easier to be wrong alongside everyone else than to be right by yourself. When you're inside the crowd, it doesn't feel like mindless herd behavior. It feels like validation. Once that consensus locks in, confirmation bias takes the wheel. It's not that investors stop looking at data completely. They just conveniently stop looking at the data that makes them uncomfortable. Good news gets spotlighted, shared everywhere, repeated constantly. Bad indicators, they get explained away, given context, dismissed as temporary noise. Valuation methods get tweaked. Standards get loosened. Words like temporary, transitional, and long-term vision start doing some serious heavy lifting. This is the phase where bubbles become bulletproof. Any information challenging the dominant story is unseen as a warning. It's proof that the critic just doesn't get the new world we reliving in. Then overconfidence creeps in, the subtle kind. When markets keep going up, participation gets rewarded. Early wins feel personal. New investors think they've stumbled onto something special. Veteran investors convince themselves they've finally mastered risk management this time around. And here's the thing, everyone believes they'll cash out before the collapse. Even though history screams that almost nobody actually does. Luck feels exactly like genius, until suddenly it doesn't. Authority bias adds the final protective layer. When big institutions validate the narrative by jumping in with their money, doubt basically evaporates. Major banks publish optimistic forecasts. Governments praise the innovation. Central banks keep conditions favorable. Money flows freely. At this point, the asset stops feeling speculative at all. It starts feeling officially approved and safe. Because nothing says, this is totally stable, like needing constant reassurance from institutions to maintain confidence, right? And here's the really cruel part. None of this feels reckless when it's actually happening. It feels like alignment with reality, like progress, like inevitability. Prices climb, confidence builds, and caution just fades away. The psychology creating bubbles doesn't announce that things are excessive, it numbs you to it. Rising prices stop being a signal worth examining and become just background noise. Volatility becomes routine. Risk becomes this abstract concept somewhere out there. And eventually the question shifts from, is this actually sustainable, to how do I avoid getting left behind? This is where modern bubbles look different from the cartoon version we imagine. They don't need mass hysteria or chaos. You don't need day traders quitting their jobs or your Uber driver giving you stock tips anymore. Today, bubbles can quietly inflate, driven by institutions, index funds, and capital concentration, with surprisingly few people actively questioning the basic assumptions underneath it all. Which brings us to right now, this moment. A growing number of investors are asking whether we're watching the early stages of an artificial intelligence bubble. Not because AI is fake or a scam, it absolutely isn't, but because the expectations surrounding it are exploding faster than the actual economics can currently support. This distinction is crucial. Every major bubble in history was built around something genuinely real. Railroads did transform transportation. Electricity did reshape entire industries. The internet did change communication forever. The dot-com bubble did explode because the internet was worthless. It exploded because capital markets assumed adoption would be immediate, universal, and perfectly profitable right away. AI is following that exact same pattern. The technology is real. The productivity improvements are real. The long-term impact will likely be massive. But markets don't price based on long-term inevitability, they price based on short-term expectations. And that's where psychology sneaks back into the equation. In recent years, a tiny group of AI-connected companies has been responsible for a massively disproportionate share of overall market gains. Index performance has become increasingly concentrated, meaning fewer and fewer companies are driving most of the upside. This concentration alone isn't definitive proof of a bubble, but it is a very familiar ingredient. When belief channels enormous amounts of capital into just a handful of symbols, those symbols start carrying narrative weight that goes way beyond their actual financial statements. Valuations rise not just because of projected future earnings, but because of assumed total dominance. Profit margins that don't exist yet get priced as if they're guaranteed to materialize. Massive capital spending gets reframed as strategic necessity. Actual profitability becomes something that'll arrive later, after achieving scale, after capturing the market, after disruption finishes rewriting all the rules. Does this sound familiar yet? This is where confirmation bias quietly does its most effective work. Positive announcements get amplified everywhere. Headlines about adoption get celebrated loudly. Negative data points, rising costs, competitive pressure, regulatory friction get explained away or contextualized into irrelevance. Skepticism isn't even debated anymore, it's just dismissed as short-term thinking. At the same time, authority bias strengthens the narrative even more. When major funds, index providers, and institutions all allocate heavily toward the same theme, belief turns solid. Participation itself becomes its own validation. The question stops being, what is this actually worth? And becomes, how badly will I be hurt if this keeps running and I'm not in it? This is the psychological shift that defines the late stage of belief formation. Not panic, not wild mania, just ... quiet alignment. And here's the uncomfortable truth nobody wants to hear. None of this requires bad intentions. Most people involved aren't being reckless at all. They're being rational, responding to incentives, benchmarks, and career risks. When underperforming relative to your peers carries real professional consequences, staying cautious actually becomes more dangerous than staying fully invested. This is how bubbles can inflate without widespread excitement or enthusiasm. They don't need everyone to be excited, they just need compliance. The mistake people make is thinking bubbles pop because everyone suddenly realizes they were wrong all along. That almost never happens. Bubbles burst because one core assumption breaks down. Maybe revenue growth slows. Maybe costs rise faster than anyone expected. Maybe interest rates shift and force capital to reprice risk. Whatever it is, the moment that core narrative loses coherence, psychology reverses direction instantly. Confidence doesn't fade gradually like a sunset. It snaps like a rubber band. And when it does, all those same forces that drove prices upward suddenly accelerate the decline. Social proof flips direction. Confirmation bias starts hunting for bad news instead. Overconfidence evaporates overnight. Authority figures retreat. Liquidity dries up. What felt inevitable yesterday suddenly feels fragile today. This is exactly why bubbles feel so obvious looking backward and completely invisible while you're reliving through them. So how do you actually protect yourself? Not by trying to predict crashes. History proves that timing bubbles is virtually impossible. The goal isn't developing perfect foresight. It's developing self-awareness. The most important question isn't, is this a bubble? It's, what belief am I currently relying on? If growth slows down, what breaks in my portfolio? If capital gets tighter, what changes? If expectations reset to reality, what actually remains valuable? When your investment decisions are anchored to narratives instead of actual cash flows, timelines suddenly matter a lot. When valuations depend on everything going perfectly in the future, patience itself becomes a form of risk. And when everyone around you feels absolutely certain about something, that's precisely when uncertainty deserves the most respect. History doesn't repeat itself because the assets change, it repeats because human psychology doesn't change. Bubbles don't form because people are greedy or stupid. They form because believing feels safer than doubting, right up until the moment it isn't. The people who survived past bubbles weren't the ones who could see the future clearly. They were the ones who understood their own assumptions and limitations. That's the real lesson buried underneath every dramatic crash chart and every post-mortem analysis headline. If this shifted your perspective at all, hit that subscribe button. History has all the answers we need. I'll show you exactly where to look.